Hello, students of macroeconomics. This is the final chapter in the macroeconomics course, chapter 16 from the McConnell-Brew textbook, Monetary Policy. So, in previous lectures, previous video online learning sessions, we discussed the Federal Reserve, the history of the Fed, the structure of our central bank. If you remember, we have the Board of Governors with the Fed chair, the vice chair, and the five other members of the Board of Governors. And then you have the 12 regional banks collectively working as the Federal Reserve System. And we have the FOMC, Federal Open Markets Committee. So think of that as the institution. When we talk about the Fed, that's the institution. When we talk about monetary policy, the Federal Reserve, our nation's central bank, monetary policy refers to the maneuvers taken by the Fed to help the economy. And what do we mean by help the economy? This is from the goals of monetary policy, right? Non-inflationary full employment level of output. So our Federal Reserve, our nation's central bank, our monetary authorities, they have what's called a dual mandate, which means they have to keep their eye on the unemployment rates and they have to monitor price level. So GDP, economic output, economic growth, that's the key to advising the economy or controlling the economy to keep price level stable and keep unemployment rate at a desirable level. This dual mandate of the Fed is sometimes criticized because other central banks, and we're going to see a list of those other central banks in a few moments, have a single mandate, which is typically just price level stability. Our Federal Reserve, our nation's central bank, monetary authorities, they have this dual role of full employment, non-inflationary level of output. You should remember aggregate supply, aggregate demand from previous lectures. This is the chapter on aggregate supply, aggregate demand preceded fiscal policy. Definitely need to remember this model as our tool to analyze macroeconomic activity. So remember, when we are examining the economy, we're interested in three macroeconomic variables, and they are GDP and unemployment, which are measured on the horizontal axis, the x-axis, and the general price level in the economy, which is measured on the vertical or y-axis. We have our downward sloping aggregate demand curve and our upward sloping aggregate supply curve. Aggregate demand is what? The level of real output that all buyers, meaning consumers, business investment, government spending, and exports, desire to purchase at the given price level in the economy. The upward sloping aggregate supply curve, remember this is the short run aggregate supply curve, demonstrates the amount of real output that producers desire to make available for sale at the given price level. Equilibrium in this market, macroeconomic equilibrium, which is designated where aggregate demand and aggregate supply intersect, yields what's going on with our economy. What phase of the business cycle are we currently experiencing? As pictured on this particular slide, this is the everything okay, Goldilocks, we wouldn't want to change a thing, economic picture of perfection. So this graph using aggregate supply, aggregate demand, the model is as seen on this board, it's registering full employment domestic output, right? What does that mean? It means that at QF, Q meaning quantity of GDP, F meaning level of employment, at QF, P1, we are achieving roughly 3% economic growth. The unemployment rate is somewhere in the neighborhood of 4 to 4.5%. And inflation, the CPI, Consumer Price Index, inflation, change in the price level, is roughly 2%. Remember, this is the goal of our economic output all the time. We want to achieve non-inflationary economic growth at all possible costs. But we know things get off kilter. We can have a decrease in aggregate demand, an increase in aggregate demand, a decrease in aggregate supply, and an increase in aggregate supply. Make sure you are familiar with this model before you proceed further studying monetary policy. Just as we applied the principles of this model to fiscal policy, government spending and taxes, which influence the economy, we're also going to talk about how monetary policy can be used to address certain economic situations that occur and what our Federal Reserve can do to get the economy back off track when it is not operating where we want it to be. What are the specific chapter objectives we intend to achieve by the time we are finished this video? Well, we're going to talk about equilibrium, interest rate, and the market for money. This is something we covered earlier, but it's important to review because the money market will ultimately determine the domestic real interest rates. So we're going to review the money market, and we're going to talk about interest rates, and we're going to talk about the different types of interest rates. We'll investigate to a much deeper level monetary policy and then how the Fed controls the economy by adjusting what's called the Fed funds rate. There's another video that students will be referred to. The video explains in detail the newest tool of monetary policy, which the Central Bank of the United States, or the Federal Reserve, now uses as its primary mechanism of manipulating the Fed funds rate. Then we'll talk about how monetary policy affects GDP, employment, and the price level. And then finally, we'll look at how effective is monetary policy, and we'll talk about some of the pitfalls or shortcomings of monetary policy. So when we talk about this idea of interest rates, right? Interest rates. So think of it in the terms of the price paid for the use of money, right? Now remember, interest rates, there's two participants. You have the borrower and the lender, right? So for the borrower, that's the price paid for the use of money. For the lender, it's the price received for making the loan available, or the money is available, the capital available. So remember that there's two sides to the interest rate equation. Borrowers, it's the price paid for the use of money. Lenders, it's the reward received for making funds available, right? Now, when we looked at and examined the money market in the previous chapter, which we're going to review in a few moments, we talked about the interest rate. But in reality, there are many different interest rates. And I'm sure you've heard many of these, such as 30-year, 20-year, 15-year fixed rate mortgages. You actually have adjustable rate mortgages. You have interest rates on car loans. You have interest rates on student loans. There's interest rates that businesses pay, right? Then there's an interest rate called the prime rate. So we're going to talk about all the different interest rates. So there's definitely more than one interest rate. However, even though there are multiple interest rates of interest, no pun intended, of concern, ultimately all interest rates are influenced by and determined by what happens in the money market, the supply and demand for money. What are some of the interest rates that you need to understand? The discount rate. We have described the Federal Reserve, our nation's central bank, as the lender of last resort. One of the roles of the Federal Reserve is to provide liquidity, provide financing, provide loans to financial institutions and banks when they have troubles, when they are having solvency issues. When a financial institution or a bank borrows monies from the Fed, they do so at the discount rate. It is the interest rate that the Fed charges these institutions to borrow funds. This role of the Fed as lender of last resort has been expanded exponentially both in the 2008 financial crisis and the current COVID-19 crisis. We will discuss more about that later. The Fed funds rate. Notice this one is in bold, it's larger, and it's in red. Therefore, it's obviously important. So there's an overnight market where banks lend reserves to other banks when a bank is short on required reserves. So if a bank has a required reserve shortfall, most of the time they borrow from other banks. So the Fed targets or sets this interest rate. Right? It's an overnight markets rate. So choose a quick example. Wells Fargo, they have a reserve shortfall. They borrow from Bank of America tonight. Right? In the overnight Fed funds market, they pay back the money tomorrow. So the Fed controls that interest rates. There's actually a separate video we will discuss about the new tool of interest on excess reserves as extremely important on monitoring, controlling this interest rate. Now, why is it so important? It's important because all the other interest rates fall in line with this particular interest rate. So we're going to talk about those interest rates: the 10-year, the prime interest rate, the 30-year, the 5-year car loan, credit cards, interest rates, student loan debts. We're going to look at a chart pretty soon. We're going to see that all of the other interest rates move in line with the Fed funds rate. The next interest rate, the 10-year Treasury, that's a bellwether interest rate. So what does this mean? You should know this by now, but just to review. Our federal government runs deficits almost every year. Federal government expenditures exceed federal tax revenues. Therefore, the government runs a federal budget deficit. To finance the deficit, the federal government borrows funds, borrows monies. They issue debt, they issue bonds, right? The most popular bond is the 10-year Treasury. So banks, other countries, individuals, insurance companies will lend money to the Federal Reserve, to the federal government for 10 years. Right? You're lending your money to the federal government for 10 years. The 10-year Treasury is important because as the Fed funds rate moves, the federal funds rate moves, so moves the 10-year Treasury, so moves the next interest rate, which is the prime rate. The prime rate is the rate that banks lend money to their most creditworthy customers. So if you're a manufacturing firm and you've been in business for 20 years and you always pay your loans back on time, you will borrow money at prime. Matter of fact, you're an extremely good customer, you have that type of credit history with lending institutions, the bank wants to keep you as a customer, they might give you prime minus a quarter. So if the prime interest rate in the economy is 1.75%, they might say, you know, we'll let you borrow money for 1.5%, right? So the prime rate, the interest rate that banks charge their most credit-worthy customers to borrow, right? Businesses. 30-year fixed rate mortgage, you've heard of this one before. I buy a home for $300,000. I have $240,000 to finance because I only have $60,000 for a down payment. So I put down my $60,000. I borrow money from a bank for the rest. I pay an interest rate. That interest rate is fixed for 30 years. The most common source of financing for home purchases. 5-year car loan, right? You go to buy a car. The car is $35,000. You put down a $2,000 down payment. You borrow $33,000. You pay it back over 60 months. Equal payments. You pay interest on that car loan, the 5-year car loan, right? Something you want to try to avoid in your life, if at all possible, is credit card debt because interest on credit card debt is extremely high. But the interest rates that credit card companies charge is influenced by the Fed funds rate and then the 10-year Treasury and then the prime rate and such, right? Something many students will have to deal with when they graduate college are their student loans, and student loan interest rates are directly impacted by what's going on in the economy, and therefore they rise when the Fed funds rate rise and they fall when the Fed funds rate fall. Okay, quick review of the money market, something we went over in a previous video. So the demand for money is made up of two aspects or two characteristics of the demand for money. The transaction demand for money, that is to say, every time economic activity takes place, money needs to be available to facilitate that transaction, the transaction demand for money. And the transaction demand for money varies directly with nominal GDP. People hold money as an asset, but there's an opportunity cost of holding money as an asset because you forego any potential interest. So higher interest rates means there's a significant opportunity cost to holding money as an asset. Again, we reviewed all this. So this is review. You should already know this. The two characteristic or aspect of the demand for money. The asset demand for money varies inversely with the interest rate. High interest rates, you don't want to hold too much money as an asset. Lower interest rates, there's not much opportunity cost to holding money as an asset. The total demand for money will be the downward sloping demand curve. It's made up of both the transaction demand and the asset demand. So we are going to be interested in the total demand for money when we look at the money markets. So over on the left here, A, there's your transaction demand for money. If the economy were to pick up speed, that would shift to the right a teeny bit. If the economy slows down, that would shift to the left a little bit. The asset demand for money, your downward sloping inverse relationship between interest rates and the asset demand for money, right? Because the interest rates being measured on the vertical axis, quantity on the horizontal axis. This is our review. All right, so we add A plus B, and we get to what we're going to be dealing with all the time, and that is C, the total demand for money. It's easy to explain the red curve. That's the supply of money, right? The supply of money. Who controls the supply of money? Well, that's the whole point of this exercise. Our nation's central bank, the Federal Reserve, controls the supply of money. Remember, think of the supply of money as S2, right? Coins, cash, checkable deposits, plus near monies of saving deposits and money in money market funds, all right? Short-term deposits of $250,000 or less. S2, that's the supply of money. You see here that given the equilibrium in the interest rates, given the equilibrium in the money market, the current interest rate in this economy is 5%. So we have $200 billion worth of supply of money and $200 billion in demand for money. Equilibrium interest rate, domestic money is 5%. Remember, that's a generic expression of the interest rate. We already explained the various interest rates that actually take place in the economy. So we will talk about the particulars momentarily, but the Fed controls the nation's money supply. Here we have an interest rate labeled R star, right? Well, the Fed can do one of two things. They can leave the money supply where it is and therefore not change the interest rate, or the Fed could increase the money supply, which would bring down interest rates. The Fed could decrease the money supply, which will increase interest rates, right? Now, this should already be old hat to you because way back in the chapter with macroeconomic relationships, we looked at the investment demand curve and we talked about the inverse relationship between the real rate of interest and the amount of planned business investments. All right, in layman's terms, higher interest rates slow economic activity. Interest rates go up, businesses borrow less and invest in fewer new projects. Interest rates go up, consumers borrow less to buy new cars. Interest rates go up, consumers buy fewer homes and refinance their existing homes less frequently. Interest rates go down, the opposite is true. Lower interest rates entice borrowing and investing in new projects, borrowing and purchasing new cars and new homes. Okay, so interest rates, when an equilibrium interest rate, right? If there's a change in the supply or the demand of money, it will change the interest rate. So when the demand for money were to shift to the right or shift to the left, increase or decrease, that would impact interest rates. And of course, the Fed controls the nation's money supply. The Fed can increase or decrease interest rates by shifting the curve right or left. Now, we discussed this in detail in the previous lecture. If you need to review this idea of the inverse relationship between interest rates and bond prices, I suggest you revisit that video. But we know that interest rates and bond prices are inversely related, which means what? Okay, I bought a bond in 2010, and it's a 10-year bond and has a fixed coupon of 3%, which means I get $30 in interest every year because it's a $1,000 bond. And at the end of 10 years, I get my last interest payment and I get my principal back, my $1,000 back, right? So we know that there's an inverse relationship between bond prices and interest rates. So, if there's an increase in interest rates, right, bond prices will fall. If there's a decrease in interest rates, bond prices will rise. Again, we covered this in detail in a previous lecture. If you do not remember, or you need to brush up on the inverse relationship between interest rates and bond prices, revisit that previous lecture. Okay, so the Fed funds rate. I explained or defined this earlier, right? The rate charged by banks on overnight loans. The rate charged by banks on overnight loans. Every bank has a required reserve. Every bank has reserve shortfalls. Therefore, they would borrow in the Fed funds market to meet their reserve requirements. They would pay back the loan the next day. At the end of the next day, the whole system starts over again. Notice the verbiage on point 2 here. The Federal Reserve targets this rate, the Fed funds rate. The Fed, quote unquote, targets the rate. The Fed can't go out and turn a dial and put it exactly where they want. As a matter of fact, when you hear the Fed funds rate reported in the economy, it'll report it saying the current Fed funds rate is in the range of 1.25 to 1.5. And that's how it's typically expressed. It's in a range. All right, we know about the FOMC. We know about the FOMC, the Federal Open Markets Committee. The primary tool of monetary policy for the longest time was called open market operations, or the buying and selling of securities, of bonds. That's how the Fed targeted the Fed funds rate. However, things change, life changes. That's why there's a separate video which does an extremely amazing job of explaining the new primary tool of monetary policy, interest on excess reserves. Again, I will point this out when we get to that portion of the lecture. This chart shows us the Fed funds rate from 1952 all the way through 2012. So you can see the Fed funds rate has been as low as 0%, which was what happened after the Great Recession of 2008. The Federal Reserve of the United States, our central bank, our monetary authorities, lowered the Fed funds rate as low as humanly possible. Right? At the same time, you look in the late 70s, early 80s, you had a Fed funds rate all the way up near 20%, 18, 19%. Right? Oh my, how the world has changed. Earlier, I explained how there was a direct relationship between the Fed funds rate and all other interest rates. So if you look at this chart, it does an extremely amazing job of graphically depicting that relationship between the Fed funds rate and all other interest rates. Right? So the blue line on this chart is the Fed funds rate. The red line is the prime rate, right? The rate at which banks lend money to their most credit-worthy customers. Then you have the 5-year and 10-year Treasury notes. But you can see the stepwise relationship between the Fed funds rate and other interest rates in the economy. Right? When the Fed funds rate goes up goes the prime rate, and all other interest rates will follow suit. An extremely useful approach to teaching monetary policy is to look at the Fed's balance sheet. Any business major has been, at least in a finance class or an accounting class, been introduced to the idea of a balance sheet. It's the classic accounting equation: assets equal liabilities plus owner's equity. Whatever you do to one side of the balance sheet, you must do to the other side of the balance sheet. So let's talk about what are the assets and what are the liabilities of our nation's central bank, the Federal Reserve. On the left-hand side, the assets. The largest asset of the Federal Reserve is securities. Now imagine if we were playing or trying to figure out the Sunday New York Times crossword puzzle, and it said 5-letter word, asset of the Federal Reserve, securities. What do they mean by that? Right? It's a fancy way of saying bonds. Right? And for the longest time, meaning all of post-World War II modern economic history, so let's say from 1950 through 2008, it was easy to explain this to students. Matter of fact, monetary policy was easy to explain to students prior to the Great Recession and the financial collapse of 2008. So these securities were government bonds of short duration, right? 1 year, 2 year, maybe 5 year notes, right? So the largest asset of the Federal Reserve was short-term bonds, securities. Another asset of the Federal Reserve are loans to commercial banks. Remember, the Fed is the lender of last resort. If a bank was having solvency issues, was having problems meeting reserve requirements, and they couldn't borrow from another bank, they could come knocking on the Federal Reserve Bank's door and ask for a loan at the discount rates. Right? And the Fed would gladly lend them the money, the lender of last resort. But remember, the bank has to pay that money back. So those loans, right, it's an IOU. The bank owes that loan, those monies back to the Federal Reserve. So that those loans are assets of the Federal Reserve Bank. Liabilities. Well, remember, banks are required to keep a certain portion of their deposits as reserves, right? The required reserve ratio. So they can keep those reserves parked in their bank, or they can keep them on reserve with the Fed. This reserve these monies on reserve at the Fed took on a whole new meaning. I mentioned this twice already, but the Fed began paying interest on excess reserves after the 2008 financial crisis, and that quickly became or transformed into the most important tool of monetary policy. Again, we will discuss this shortly. Other liabilities of the Fed, this one's not a big number, but something we should definitely at least acknowledge and talk about. Remember, the Federal Reserve, our nation's central bank, they act as fiscal agent for the federal government, which means Washington, D.C., Congress, they have a bank account with the Fed. All right? Our nation's federal government takes in large amounts of tax revenues each year. All right? 2019 tax revenues were roughly $3 trillion. Right, so the federal government needs a place to park these monies. They put it in their bank account with the Federal Reserve, right? So of course that's a liability to the Federal Reserve because it's the federal government's money. Another New York City crossword clue. This would be a good one for this Sunday. New York City crossword. Federal Reserve notes outstanding. The largest liability of the Federal Reserve, right? During normal times, I should say, prior to the crazy, wacky life that we have now. Well, actually, still the largest one, but cash, right? Federal Reserve notes outstanding, cash. So the cash that's in circulation is simply debt that's been issued by our nation's central bank. Here are the numbers prior to the Great Recession. Back in the old easy days of teaching monetary policy, it was straightforward and simple to explain how our nation's central bank managed the money supply and influenced interest rates. All right, so the Fed had 714, right? This is, in millions, these are, billions of dollars, $714 billion worth of securities, which was offset almost perfectly by cash, Federal Reserve notes outstanding, right? Notice that the other numbers are relatively small compared to those numbers, right? So those are the two important. The most important number on the left were the securities, the most important number on the right were the federal notes outstanding or cash. So the Fed's balance sheet prior to the Great Recession was less than $1 trillion, right? $885 billion, less than $1 trillion. Notice this will change dramatically after the financial collapse, the housing bubble burst, and the Great Recession of 2008. Just 2 years later, right? Just 2 years later, we look here and say, here's the Federal Reserve balance sheet changes. So if you look and say, okay, in 2005 they owned $717 billion worth of securities, of bonds. Well, that went up to 776. Not a huge change. But look at these other bonds. The big one here is mortgage-backed securities. The Fed introduced a program known as quantitative easing, where the Fed began to purchase financial assets they had never been involved with before. So if you look in 2005, the Fed owned $0 worth of mortgage-backed securities, right? Then all of a sudden, the Fed owned $908 billion worth of these securities, right? The Fed also started to buy long-term debt, federal agency debt securities. So the Fed's balance sheet between 2008, which we saw on the previous slide, of $885 billion, had doubled just 2 years later in 2010. And that was just the beginning. This slide demonstrates the enormous exponential expansion of the Fed's balance sheet as a response to the 2008 financial crisis. So on the vertical axis, this is as a percentage of GDP, and as a percentage of gross domestic product, the Federal Reserve's assets, right, and composition of the assets. So notice back in 2007, we looked at this 5% of gross domestic product when you look at what the Fed held in assets. And remember, it was mostly, you look at the blue, traditional securities, right? Mostly traditional securities. That was for the largest component of the Fed's balance sheet. So what is quantitative easing, and why was it used by the Federal Reserve? So the Federal Reserve, and we'll go over these in more detail in a few slides, prior to the Great Recession, had three primary tools of monetary policy. The first one, the discount rate. So the rate that the Fed charges banks who need to borrow from the Fed, right? The lender of last resort. Well, the Fed, they lowered that as much as they possibly could. Right? The next tool of monetary policy is open market operations, which is buying and selling of bonds to influence the Fed funds rate. In other words, to get the Fed funds rate down. Now, we already saw that when the Fed funds rate decreases, the rate on mortgages and car loans and credit card loans and credit card debt all decrease, but the Fed got that down as low as possible as well. So the Fed had the Fed funds rate at or near zero, the discount rate as low as possible. Right? The Fed could have manipulated the banking system by altering the reserve requirement, the 10% required reserve ratio, but sort of a risky proposition when banks were the institutions that caused the financial collapse to begin with. So the Fed came up with this new approach to adding liquidity to the market of expansionary monetary policy, and that was quantitative easing. And quantitative easing involved the Fed purchasing two new asset classes, two new types of financial instruments. The two largest, we just mentioned one on the previous slide, mortgage-backed securities. And if you look at this graph, that's the green. We'll call it the dark olive green, not that lime green, right? And you can see the enormous expansion of the Fed buying those financial assets, and the Fed buying long-term, right? Long-term Treasury purchases, right? So mortgage-backed securities, why did the Fed do this? Well, remember in the previous video we talked about the causes of the 2008 financial collapse, and one of them was called securitization. That is to say that banks took a group of mortgages, they packaged them together, and they sold them off as financial assets, right? We thought of this as a way to diversify the risk that was involved with subprime mortgages. So if we have 100 borrowers who have less than perfect credit, we know maybe a certain percentage of them won't pay back their loan. So if we take all of their loans, we package them into financial securities, and we sell them off. In theory, we're diversifying the risk. But then we talked about all the wackiness that went on with credit default swaps, and then it went even layers further with more derivative instruments, with insurance on swaps, and collateralized debt obligations. Long story short, no one wanted to buy mortgage-backed securities. So the Fed became basically a market maker in mortgage-backed securities. Now, a good financial lesson for anyone still listening is that the many times in the history of stock markets and financial markets, the best time to buy any financial asset is when no one else wants it. So the Fed started buying these mortgage-backed securities. They actually ended up making a nice amount of money because after the Fed put a floor in that market, the value of those mortgage-backed securities started to rise again. So you can see the enormous expansion of the Fed's balance sheet when they began buying these mortgage-backed securities, right? And then the idea of long-term treasury purchases. Our nation's central bank began to what we call monetize the debt. Now, what does that mean, monetize the debt? It means this. The Federal Reserve, our nation's central bank, was purchasing long-term government bonds directly from the federal government. So the federal government was, in essence, now it's not proper to say this, but it's paramount to doing this, printing money, right? Printing money. That is to say that our nation's federal government would issue debt and it would be bought by our nation's central bank, the Fed. So you can see that huge expansion there of the red section of this QE2, QE3, right? So we had these several rounds of QE1, QE2, QE3. We are currently in the midst of the 2020 COVID-19 pandemic, and quantitative easing is being reintroduced as a tool of monetary policy. The Fed has already expanded its balance sheet beyond what I would say is any logical, fathomable number. So, we're going to look at the Fed's expansion of the balance sheet on the next slide from prior to the 2008 economic collapse and what happened afterwards. But the Fed's expanding its balance sheet by perhaps as much as another $4 or $5 trillion because of this financial crisis. I should say because of this economic crisis. So here's your quantitative easing. November 2nd of 2008 was the first round of easing, and then 2010 another, right? September 2012, right? And it shows you the numbers, and then again QE4 2012. So there were 4 quantitative easing programs, and you can look at the enormous expansion of the Fed's balance sheets. Here are the numbers, right? You look and say, by 2015, this is July of 2015, the Fed's balance sheet, which was, remember, if you're from the previous a few slides back, all right, prior to the 2008 financial collapse, the Fed's balance sheet was $885 billion, so less than $1 trillion. Now you look at the expansion of the Fed's balance sheet by July of 2015, which is a mere 7 years later, right? $4,480 billion, right? So the Fed's balance sheet had grown 5-fold in that amount of time. Now again, 2020 we have this COVID-19 economic crisis. Again, this was not a man-made crisis. This was just a pandemic that was unavoidable. It was nothing to do with any missteps in the financial community or irresponsibility of banks or financial institutions. Right? It wasn't a housing collapse caused by overzealous buyers and exorbitant prices and finally coming to realization that these prices were out of whack. This is just something that was basically unavoidable. But the Fed is now making loans to all kinds of institutions, car companies, right, and small businesses and such. So we're going to see the Fed's balance sheet expand from just under $5 trillion to maybe as high as 10, possibly $11 trillion. So when we talk about that role of the Federal Reserve as the lender of last resort, it's kind of interesting to analyze, especially as somebody who's taught and followed monetary policy for a few years now, how the Fed can reinvent itself to help out with the economy when absolutely necessary. The Federal Reserve is not the only central bank in the world. Here's a list of various countries across our great globe and the central banks associated with each of these nations. Take notice to the Eurozone, the ECB, or the European Central Bank, is equivalent to our nation's Federal Reserve. So that's an interesting proposal because in many ways each member nation of the EU has forfeited some of the control of their own monetary policy, as the European Union now has a central banking system. Now some countries still issue their own debt, so it's kind of a combination of both approaches. This is an interesting slide because it shows you that the whole idea of monkey see, monkey do, follow the leader type of behavior. This shows you central bank's balance sheet in advanced countries as a percentage of GDP, the expansion of balance sheets. So it shows you the Fed started this idea of quantitative easing back in 2007, and then the Bank of Japan, the European Central Bank, the ECB, and then the Bank of England, they all followed suit to take the same exact measures because it appeared to be working for the United States. So why not try it in these other countries? If what works for one country might be good medicine for the other nations. Let's now discuss in detail the tools of monetary policy. This is what I would say is interesting and frustrating about being a professor of economics, specifically a professor of macroeconomics, because unlike other economic theories or principles or concepts, monetary policy has changed a great deal since the economic downturn of 2008, which makes it interesting to be a practitioner of this particular social science. But again, it also makes it challenging because you have to keep up to date with these changes. And when we're going through these specific alterations in the way monetary policy is carried out, it's impossible to clearly communicate the true nature of these policies to students because, quite honestly, no one had ever heard of these things, right? So we'll talk practicality as we go through these. So number one tool of monetary policy. If we look at the period of time from, say, 1950 through 2008, prior to the Great Recession, we would say that the Fed carried out monetary policy largely by open market operations. And open market operations is a fancy way of saying the Fed bought and sold government bonds. So when you hear that term, open market operations, that tool of monetary policy refers to our nation's central bank buying and selling government bonds. And remember, for the longest term, again, from 1950 to 2008, we're talking about buying and selling short-term government bonds. So, your 1 year, 2 year, maybe your 5 year treasury notes, right? So, short-term government bonds, open market operations. Again, this was the primary tool of monetary policy for the longest time. We will look at the cause and effect relationship between the buying and selling of bonds and how that ultimately affects reserves at banks and the money supply and interest rates. For now, the definition will suffice. The next tool of monetary policy, the reserve ratio. Remember, we work on a banking system with fractional reserve banking. In other words, banks do not have to keep 100% of their deposits in their vaults or on reserve with the Fed. Banks are permitted to lend out a percentage of their checkable deposits. So the reserve ratio in 1992, the required reserve ratio was 12%. In 1992, the Fed reduced that number from 12% to 10%. So commercial banks have to keep 10% of their checkable deposits on reserve with the Fed or in bank vaults. Now, here's where this gets a little bit not so crazy difficult to explain. It is now almost the end of April 2020. The entire world is suffering through and attempting to deal with the COVID-19 pandemic. Obviously, the physical fallout, the health and well-being of people is of most importance, but we know that there's economic fallout associated with this pandemic. The Federal Reserve, our nation's central bank, is attempting to do everything in its power to alleviate some of that economic suffering. So the reserve ratio was reduced from 12% to 10% in 1992. And most economists, when I say most, I would say 999 out of 1,000, assumed the required reserve ratio would remain at 10% for the indefinite future. And when I say indefinite future, I'm talking most likely 100 years or something. All right, COVID-19 interferes economic activity around the globe. The Fed has decided to take extraordinary measures, and the Fed has lowered the required reserve to 0%. Now, we said this in a previous video when we covered reserve ratio, when we introduced the functions of the Fed. The reason why this is so challenging to explain is because remember the term or the idea of what's called the money multiplier. All right, one bank receives a new deposit, they lend out all of their excess reserves. Those excess reserves become new monies in the economy. That new money makes its way into another bank. Now a new bank has excess reserves and can make a second loan. And so on and so on. We call that money creation expansionability, right? Expandability of the banking system, the money multiplier. So 1 over the required reserve ratio, 1 over 0.1 is your money multiplier. But now we have 1 over 0 because there's no more required reserve ratio. Theoretically, the money multiplier is now infinite, infinitely large. Two things to remember. Number one, banks don't always lend out all of their excess reserves, especially when we look at this fourth tool of monetary policy. Likewise, the money multiplier assumed that when new monies were created, when a loan was created, those new monies immediately found their way into another bank. We know that's not the case in the real world either. Right? Another important idea is this. We are taking a survey course here. This is introductory macroeconomics. There is a specific course designed to examine money and banking in grave detail. So if you're interested in this topic, you can take an entire 15-week college course on just monetary policy, money and banking, and the financial institutions. So I know it's a little bit challenging to think in those terms, like you say, okay, this is a little vague, but theoretically, the money multiplier is now infinite because the required reserve ratio has been cut to 0. Okay, the discount rate, one of the other tools, another tool, the third tool in this row of monetary policy is called the discount rate. When banks or financial institutions can't get other banks to lend to them, they can come knock at the Fed's door, the lender of last resort. Right? So for the longest time, this was what we called a passive tool of monetary policy. It had what economists refer to as an announcement effect. In other words, when the Fed wanted to announce to the economic and financial community where they believed Fed policy was headed in the future. In other words, was the Fed going to ease, that is to say, lower interest rates to try to stimulate economic activity, or was the Fed going to tighten, raise interest rates to slow economic activity down a bit, right? They would do so by adjusting ever so slightly the discount rate, right? Now, why do we mean it was a passive tool? Because in the good old days, meaning prior to the 2008 financial collapse, only 3% of reserve shortfalls were borrowed from the Fed. In other words, most of the time when banks had liquidity issues or they were short on required reserves, they could easily borrow from another bank. It was rare that a bank had to come knocking at the Fed's door. So the discount rate was a tool available to the Fed, but it was hardly ever used because it wasn't needed. That all changed in 2008. Now, it's also changed a great deal in 2020. The Federal Reserve is instituting massive programs to lend to all different players in the economy. So, again, it makes it interesting to teach monetary policy, but it makes it challenging because this is happening as we speak. I couldn't accurately tell you everything that's happening because It's sort of being put in place, and we don't know the economic implications of the policy yet. And we don't really know how well it will work, and we don't know how we're going to get out of the policy after this happens. But we know it's part of the program instituted by the Fed to address the COVID-19 economic pandemic, and that is to say, to expand its role as lender of last resort, to expand loans to members of the economy through the discount window. All right. Now, again, another interesting, we'll say, phenomena of the 2008 recession was the last tool of monetary policy, something that didn't even exist or was never been taught in textbooks until the financial collapse of 2008, and that is what's called interest on excess reserves. So there's a separate video which does an amazing job of explaining interest on excess reserves. All right. Long story short, for now, before you can watch the video on your own time because it's about 6 minutes. Excellent piece put together by the Wall Street Journal. The Federal Reserve began paying interest on excess reserves. That is to say, if a bank took in checkable deposits and had reserves that they, in theory, could loan out to customers, those banks might, instead of making new loans, put some of those monies on reserve with the Fed and receive interest on those excess reserves, right? That's the idea of interest on excess reserves. So the tools of monetary policy, right? Open market operations was the most widely used forever until the Great Recession, and then interest on excess reserves replaced it as the most important. The reserve ratio, which was changed in 1992, see here it says last changed. Right? Most people thought it would never be changed again. It was 10%. After COVID-19, it's now 0%, and that has a huge impact on our principle called, our concept called the money multiplier. Right? The discount rate was a passive tool, and now the Fed has expanded its role as lender of last resort. This interest on excess reserves, which I explained a bit earlier, and that separate video you should watch to go over this important new development in monetary policy, interest on excess reserves. So let's talk a little bit then about open market operations. Right? The most common tool of monetary policy for the longest time, the buying and selling of government securities, of bonds, right? Now, the Fed could buy or sell bonds with banks. The exchange could take place with commercial banks. It could also be with the general public. And there's implications to, we'll say, how expansionary monetary policy could be when you talk about whether the Fed is buying bonds from banks or from the general public, right? We know that all tools of monetary policy are instituted to influence the money supply, right? So a quick explanation here. We're going to go into more detail in the next few slides. If the Fed buys bonds to commercial banks, reserves are increased. That is to say, banks are holding more reserves. And when the Fed sells bonds, sells securities, the excess reserves of banks are reduced. That is to say, banks are holding less reserves. Remember this. This is an important idea. Right? For the longest time, the Fed carried out monetary policy primarily by affecting the amount of excess reserves that banks held. Because remember, if a bank is holding excess reserves, a bank is in a position to create new monies. The bank can loan out those excess reserves, and the money supply increases, which brings down interest rates. Right? So the Fed carried out monetary policy using open market operations, which directly impacted the amount of excess reserves that banks were holding, and therefore the money lending process and money creation process, and how money supply would either increase or decrease based on the Fed's decision to buy or sell bonds. This pretty much sums it up on how it works. Right? If the Fed buys government bonds, the money supply increases and interest rates falls. It's kind of good to have this simplified approach to it. Understand what we mean, all right? So if the Fed buys bonds, that means the money supply will increase and interest rates will fall. We will go into the step-by-step process, right? But this is good to have the big picture. Fed buys bonds, all right? Money supply increases, Good, interest rates fall. We know that lower interest rates tend to stimulate economic activity, right? If the Fed sells bonds, money supply decreases, interest rate rises. So let's see how this works. The Fed buys $1,000 bond from a commercial bank, right? A commercial bank now is in a position to make a new loan. Well, how much of that $1,000 can the commercial bank loan out? This is an important idea. When the Fed buys a bond from a bank, the Fed has not opened up a banking account at this particular branch or with this particular bank, right? All of the new monies that the bank is holding represent excess reserves, right? Think of it like this. ABC Bank had a bond. They gave the bond to the Fed. What did the Fed give them? $1,000. ABC Bank now has $1,000 in excess reserves, right? Assuming that ABC Bank did not have any excess reserves, could not loan any money prior to this transaction, now the bank, ABC Bank, is in a position to make a new loan and expand the nation's money supply. This is an example from the McConnell textbook. They said if the money multiplier were 5 based on a reserve ratio of 20%, that $1,000 in new excess reserves could eventually grow to $5,000 in the banking system. Now remember, I'm not sure why McConnell does this. I hope it doesn't confuse students too much. It's from the textbook. That's why I'm covering it. The McConnell example assumes that the required reserve ratio is 20%. 1 over the required reserve ratio is how we calculate our money multiplier. 1 over 0.2 equals 5. A bank that has $1,000 in new excess reserves creates a new loan. Those new loans make their way into the banking system. Each new loan immediately makes its way into the next bank. Money is not leaked out of the system. Banks lend out their excess reserves, and what happens? The banking system creates $5,000 in new monies. This relationship would be slightly different if the Fed were to buy the bond from an individual, from the public. So, Bill Gates owns a bond, right? Bill Gates sells his bond to the Fed. The Fed buys that bond. So, the Fed is still buying bonds. The Fed buys the bond from Bill Gates, right? What does the Fed get? The Fed gets the bond. What does Bill Gates get? Bill Gates gets the cash. Bill Gates deposits it into his bank. $1,000 into the bank, okay? But look, the bank can't lend out all of that. The bank has to keep some of that as required reserves. If the reserve requirement is 20%, the bank can only lend out 800. So, notice that when the Fed buys bonds from the public, the money supply does not increase as much because why? Oh, geez. The money multiplier is still the same, but the amount of excess reserves that the first bank was holding is a little bit less. Now, we went through all of this discussion, and just 4 slides ago, we explained there is no reserve requirement anymore. Holy jamoly, right? So, this principle or idea or concept, it's good to review because I believe after things settle down, that might not be for a year, it might not be for 2 years, heck, it might be 3 to 5 years. Eventually, the Fed will reinstitute the reserve requirements. And this relationship between open market operations, buying bonds from a bank versus the public, will be reinstated. So it's important to review these principles, even though they might not seem all that practical today, given the fact that there is no required reserve in the current banking system after the COVID-19, we'll say, transformation of monetary policy. All right, so how does the Federal Reserve, how does our nation's central bank ultimately influence economic activity? What do we have here? This is a picture of a recession, right? We got price level on the vertical. We have GDP and unemployment on the horizontal. At Q1, right, GDP, economic growth, is weak. It's negative. It's falling, right? Which means what? Unemployment is high, right? If everything was perfect, that aggregate demand curve would be shifted well to the right into the range 2, right, at full employment output, but we're not there. All right, so this is the economy of 2008. Unfortunately, this is the economy of 2020. There's severe decrease in aggregate demand. Businesses are not investing in new projects. Households are not spending on consumer durables, right? We're in a severe recession. We know what we want to happen, right? Right now, there's not much inflation. That's not the problem. But GDP falling, unemployment rising, deeper and deeper into recession. The question is, what can our nation's central bank do to alleviate the economic misery? We know the federal government can cut taxes and increase spending. We know the fiscal policy options, and we already discussed some of the repercussions of those fiscal policy options, such as bigger deficits. But what about monetary policy, right? Now, here's the thing. We know ultimately the goal. The ultimate goal is for the Fed, our nation's central bank, to influence more economic activity, to stimulate aggregate demand, to shift the AD curve to the right, to get the economy heading back in the right direction, get positive economic expansion back on the books, and bring down unemployment, right? How does the Fed do this? Well, we go through this and say, okay, we know there's a recession, so there's high unemployment, GDP falling. Inflation, not a problem, right? The Fed's going to look at these various tools of monetary policy. The Fed can buy bonds, lower the reserve ratio, lower the discount rates, right? The Fed could also manipulate the interest on excess reserves. All of these policies would increase the amount of excess reserves that banks hold and reduce the Fed funds rates. The key idea here is this. When the economy is in a recession, the Fed will institute expansionary monetary policy. We know that the traditional tools of monetary policy are, we'll say, a bit antiquated. In addition to the required reserve ratio, the discount rate, and open market operations, the Fed has initiated new programs, right? Quantitative easing and interest on excess reserves. All of these monetary policy tools perform the same function, and that is to bring down the Fed funds rate, which increases the nation's money supply, right? So the whole idea here is let's increase the nation's money supply. We know that an increase in the nation's money supply ultimately brings down interest rates. And that's the whole key to kickstarting the economy. The Fed's going to do everything in its power to bring down interest rates when it is necessary to kickstart the economy, when it is necessary for the Fed to step in and try to alleviate some of the suffering. So look up top there, expansionary monetary policy, right? The Fed sees GDP falling. The Fed sees unemployment rising. The Fed understands price level inflation, not a problem. So the Fed knows, geez, we got to get unemployment rate down. We got to get GDP moving in the right direction again, economic growth. All right, what are we going to do? Everything in our power to increase the nation's money supply. An increase in money supply will bring down interest rates, which should stimulate some economic activity. And that's exactly what happened. Hopefully, investment spending increases. All right, Joe and Jane and Jim and Jerry, they go out and they buy a car. Somebody refinances their home. So lower interest rates tend to stimulate economic activity, which means that aggregate demand shifts to the right. We get things back on track. It might take a while. Things start to at least get a little better, right? Aggregate demand positive again. Economic expansion a little bit better. Unemployment rate starts to fall. With a rising increase in real GDP, unemployment rate drops a bit, and the Fed has managed to help the U.S. economy through expansionary monetary policy, increasing the money supply, and lowering interest rates. This slide is of utmost importance because it shows us in 3D, I should call this, right? 3D meaning three graphs, how monetary policy works. All right, let's start down bottom. This simply shows us the picture of the U.S. economy. This is macroeconomic equilibrium at its current state. That's the same exact as it was 2 slides ago. The economy has slipped into recession. AD1 intersecting with AS, right? We have falling GDP, significantly high unemployment, no upward pressure on prices. Look up top, straight up, where it shows you the investment demand curve, right? Up and to the right, up and to the right. It shows you that given the current interest rate, there will be a certain level of investment spending. All right, remember, businesses, they plan out their projects. How much should we purchase in new machines? How much should we expand our ownership of equipment? How much should we consider buying a new factory or building a new plant? Well, lower interest rates stimulate those type of spendings. Higher interest rates stifle those type of expenditures. So the Fed controls the supply of money in the graph up top on the left, the money markets. Now, it looks extremely high here. This is a textbook example. But the current interest rate is 10%. Right? That's not gonna be good for our economy when we want to kickstart economic activity. Well, what the Fed's going to do is they're going to increase the nation's money supply. Right? Increase the money supply brings down interest rates. Lower interest rates increase investment spending a bit. And then aggregate demand will shift to the right. Remember, the multiplier effect, not the money multiplier. Our good friend, the GDP multiplier, should also help, right? So the Fed sees orange aggregate demand, AD1, intersecting with aggregate supply. Weak economy, GDP falling, unemployment rising, no upward pressure on prices. The Fed looks and says, geez, at that current rate of interest, we're not really seeing much spending by businesses on new projects and equipment. What if we can increase the money supply, which brings down interest rates? That'll stimulate economic activity. Remember, personal expenditures would increase at lower interest rates as well. People refinancing their homes and people buying more cars. This slide sums up how expansionary monetary policy works. Number one, the Fed reacts to the economic downturn by increasing the money supply. Increasing the money supply means interest rates will fall. That stimulates some consumer expenditures and some investment expenditures. It also, other things equal, means that the dollar would weaken. Now, that's assuming that other nations don't institute similar monetary policy, but assuming that's the case, right? We have lower interest rates in the United States. All right, other things equal, that means the dollar would depreciate, which means that would be good for our good old exports. Exports would increase. So expansionary monetary policy lowers interest rates by increasing the money supply, and that's positive for consumer spending, it's positive for gross business investment, and it's good for net exports because we sell more American goods and services to people living in other nations. Now, I hope this happens in my lifetime soon, right? I'm sick of dealing with recessions. 2008 collapse, 2020 COVID crisis. Only 12 years between major economic downturns. Perhaps when things get back on track, perhaps by 2023 we'll be like, oh man, we're glad we got this darn virus under control and everybody can go back to going to the movies and ball games and bars and restaurants. Hooray. But maybe the economy is cooking along at too fast of a pace, right? Perhaps all of the expansionary fiscal stimulus and the monetary stimulus, right, it all caught up with us 3 or 4 years down the road. And now we have too much money chasing too few goods. So this current picture shows us inflation. Remember, fiscal policy options for combating inflation were increasing taxes and cutting spending. Not exactly popular with voters. The beauty of monetary policy is that it's independent, right? So, What can the Fed do to get things back on track? On the previous slide, we identified inflation is the problem. Instead of expansionary monetary policy, now we need contractionary, restricting, Fed tightening. Right? Instead of Fed easing or Fed expansionary monetary policy for a recession, now that inflation is the problem, we need restrictive monetary policy, Fed tightening to combat the inflation. So the Fed needs to figure out a way to reduce the nation's money supply, which will push up interest rates. So the Fed can achieve this goal by selling bonds, right, open market operations, increasing the interest on excess reserves, increasing the discount rate, or increasing the reserve ratio. All of these will start to shrink the amount of excess reserves that banks are holding, which means the Fed funds rate will rise and the money supply will fall, right? As the supply of money falls, interest rates will go up, right? Interest rates go up when the supply of money falls, and that will be bad if you're trying to expand your business. Now, this might sound counterintuitive, but remember, the problem for the moment is inflation, right? So the Fed actually wants to slow some economic activity because inflation is too much money chasing too few goods. So the Fed can push interest rates up to discourage investment spending. And it will also discourage consumers from purchasing automobiles or buying new homes, right? So higher interest rates stifle economic activity. Investment spending falls, some consumer expenditures fall. Aggregate demand starts to decline or decrease, and that has the intended effect of bringing inflation back to an acceptable level. So same graphs here, we see this as we did before. Everything moves in the opposite direction, right? So let's start down bottom. The orange AD1 aggregate demand curve demonstrates what? We are experiencing demand pull inflation, right? Aggregate demand, spending is excessive. Aggregate demand is beyond full employment domestic outputs, right? GDP, not a problem. Unemployment, not a problem. But look at inflation at P1. So the Fed can reduce the nation's money supply up top on the left, right? Up top on the left, reduce the nation's money supply, pushing interest rates up, in this case from 8% to 10%. At higher interest rates, there's going to be fewer projects where the expected rate of return exceeds the real rate of interest. There'll be fewer consumers financing purchases, which will reduce aggregate demand. Aggregate demand declines, and that brings inflation back to a more acceptable level. We see the green AD2 downward sloping aggregate demand curve. At the new macroeconomic equilibrium, inflation has fallen quite a bit. And history has demonstrated that the Fed is quite capable of reining in inflation, of soaking up spending out of the economy, at discouraging investment and discouraging consumers from purchasing any type of products they need to finance. So a quick summary of how contractionary policy works. The Fed, using its tools of monetary policy, will decrease the nation's money supply. Decreasing the nation's money supply pushes up interest rates. Higher interest rates discourage some consumer spending on durable goods or any type of spending which needs to be financed. Less investment spending because fewer projects are available where the expected rate of return is greater than the real rate of interest. It also makes the dollar strengthen. Higher interest rates attract foreign capital into this country, foreign currencies to buy bonds, And then, of course, what happens? Net exports fall. So consumer spending falls, investment spending falls, exports fall. All of that weakens aggregate demand, and that brings inflation back to an. Let's finish this video by discussing some of the advantages and disadvantages of monetary policy. First, the strengths or advantages of monetary policy. The number one strength of monetary policy is the speed and flexibility of monetary policy. Unlike fiscal policy, where you need a group of politicians to get together, the House and the Senate, Democrats and Republicans, who haven't exactly seen the world eye to eye over the last 20 years, they have to succumb to some monumental agreement on tax cuts or spending or some type of government program to address an economic concern. That could take a while, even if they recognize the severity or the seriousness of the situation and the need for almost immediate action. Politics takes time. The Federal Reserve isn't strangled by these particular political issues. The Fed can act speedily and flexibility whenever and wherever necessary. A few practical examples of this. In 1987, stock market crash, October of 87, the Fed stepped in immediately. Alan Greenspan was Fed chair at the time and lowered the discount rate and the Fed funds rate by half a percentage point. Alan Greenspan understood banks were concerned about what are known as margin calls. Sometimes individuals and institutions buy stock on margin. So imagine if you had a portfolio of stocks worth $1 million. Well, you could borrow against the value of your existing portfolio to purchase more shares. Well, when the stock market drops by 40%, the value of your existing portfolio has dropped 40%, or roughly thereabouts. Obviously, there was concern that if and when banks made margin calls, that those individuals and institutions who had bought stock on margin were not going to be able to pay these margin calls, and that would create crisis, panic in the banking system. So the Fed, in essence, in layman's terms, stepped in and put confidence into the system, letting the banks know, if and when you need the cash, here it is. Don't worry about liquidity crunches. Right? Again, after 9/11, we had serious threat to global financial and economic security. The terrorist attacks, not only did they catch everyone in the globe off guard, they posed a threat to the economic well-being of the United States and our mutual trading partners and allies across the globe. We had to shut the stock market for several days. Again, the Fed stepped in. Alan Greenspan cut the Fed funds rate by half a percentage point and the discount rate by half a percentage point. So the speed and flexibility of monetary policy. 2020, COVID-19 pandemic. The Fed realized immediately the severity of this pandemic and the serious economic calamity it's going to wreak across the globe. The Fed funds rate was ranging between 1.25 and 1.5% prior to the pandemic. A few days after the COVID-19 disease began to force American businesses to shut their doors, the Fed cut the Fed funds rate from that level of 1.25 range down to 0.5 range, and a week later cut it down to its lowest level possible, down to the 0.250 range. Quick monetary policy. Reaction to global pandemic. That's one of the beauties of monetary policy, speed and flexibility. Another advantage of monetary policy is the isolation from political pressure. Right? The Fed is made up of the Board of Governors. The Board of Governors are selected by the president and approved by Congress, but they are not a political institution. They're not running for office. Therefore, the Fed can take measures to correct what they think is going on. They can do what is correct or what is right, not what is popular. And that's not going to work if you're a politician. Sometimes politicians do what is popular and not necessarily what is right. The Fed can do what is right, not necessarily popular. A practical example of this is the economy known as cost-push inflation, stagflation of the late 70s, early 80s. It was a period of time when the United States was in a recession, falling GDP, rising unemployment. At the same time, inflation, price levels were increasing. This created an economic enigma, a problem that economists and politicians had never faced before. Paul Volcker was the Fed chair at this time, and Paul Volcker rationalized if inflation were brought under control, the economy would right itself. In other words, we could foster economic growth by cutting off one of the two heads of the double dragging high unemployment and high inflation, high price levels. So Volcker rationalized, hey, let's go after inflation and GDP and unemployment will improve. This was extremely unpopular among business owners and among individuals in the business community because if you own a business and you're borrowing, whether it's short term or long term, for operations or expansion, increases in interest rates make those costs more expensive. So they were up in arms about the idea of, hey, we're in a recession. The demand for our goods and services is down. We've laid off employees, and you're making it even more challenging by raising interest rates. Although it was extremely unpopular, it was immensely successful. Within 18 months, inflation had fallen from over double digits, 12%, down to 9%, and within another 12 months, inflation was down below 7%. So politically unpopular, however, as far as policy, extremely effective, right? Now, some of the problems with monetary policy, well, one would be what we call the recognition lag. Maybe we could levy this criticism of monetary policy during the Great Recession of 2007, that the Fed never saw the crisis of collateralized debt obligations and swaps and mortgage-backed securities and securitization. They never, as a matter of fact, Alan Greenspan was the Fed chair when all this began, and he was a huge proponent of the very same financial instruments which caused the problem. So one criticism was that sometimes the Fed doesn't recognize or realize that there's a problem taking place until it's too late. Then we have this idea of the liquidity trap, right? The liquidity trap, all right, let's say monetary policy becomes ineffective due to a very low interest rates combined with consumers who prefer to save rather than invest in, a high yielding bond or some other fixed instrument, right? So a liquidity trap is it's a function of an economic condition. It's also a psychological condition for consumers, right? So they decide, it's probably best for us to hoard cash instead of choosing high-paying investments, right? Because they have negative economic view, right? And they also might think like, well, interest rates are going to go up. Why would I invest now, right? And in many ways, it's not just limited to bonds, this idea of the liquidity trap. All right. It also affects other areas of the economy because consumers are spending less on products, which means businesses are less likely to hire more people. So this idea of, sometimes monetary policy is ineffective because very low interest rates don't do what they were supposed to do, right? The last criticism of monetary policy is referred to as cyclical asymmetry. All right. So we briefly discussed the proper monetary policy actions that the Fed should take when the economy is experiencing inflation. The Fed wants to soak up money out of the system. The Fed wants to reduce the money supply, increase interest rates, and slow economic activity to bring inflation back down to an acceptable level. And evidence suggests, history suggests, that the Fed is extremely effective at reducing inflation through restrictive monetary policy, through Fed tightening. The same can't be said for expansionary monetary policy, especially during extremely bad economic times, extremely dark economic times. Right? There's an old adage: you can lead a horse to water, but you can't make him drink. Right? If the economy is in dire straits like it is right now, I mean, there's no businesses that are even operating in 2020 because of the coronavirus pandemic. No business is going to borrow and invest in new infrastructure or new projects because there's no expected rate of return on selling goods and producing and selling services. Now, there's a few exceptions. The Amazons of the world, they can't keep enough people employed, and they're at wit's end to keep up with demand. And as important as Amazon is and your Walmarts are and some of your supermarkets, the economy is $21 trillion wide, right? So most businesses don't see any incentive to borrow and invest in new projects when the economy is in such bad shape. So the idea of cyclical asymmetry, that the Fed restrictive monetary policy aimed at bringing inflation under control, highly effective, expansionary monetary policy with the goal of increasing aggregate demand doesn't always get the same bang for the buck, or any bang for the buck, so to speak. All right, good luck studying for exams related to monetary policy, and that concludes this video lecture.